Welcome to Talk Tickers, where we break down the most recent earnings calls so you don't have to. Today, we're jumping right into Atlas Energy Solutions and their Q2 2025 results.
So what's the story with Atlas this quarter? Well, the headline numbers were kind of confusing, right? On one hand, they beat revenue estimates, but on the other, they missed on earnings. So let's dive in and figure out what's really driving the narrative here.
Okay, here's how we're going to tackle this. We'll start with a quick snapshot of the results. Then we'll get into management's strategy, what they're thinking. After that, we'll see how that plan holds up against the market reality, and we'll wrap it all up with our take on what to expect next.
First up, let's hit those high-level numbers from the quarter. So right here, this is the main puzzle. Revenue absolutely crushed it, almost $289 million, when Wall Street was only looking for about $239 million. That's a huge beat. But, and this is a big but, that top-line strength just didn't flow down to the bottom line. Adjusted EBITDA came in at $70.5 million, which was right at the low end of their own guidance, and they actually posted a GAAP loss of 4 cents per share.
Now, despite that earnings miss, management was really quick to point this out. Cash flow. The company generated a very healthy $48.9 million in adjusted free cash flow, and that's a key number for them, a signal that the core business is still churning out cash.
And that cash generation is exactly what supports their dividend, a solid 25 cents per share. That's management's way of telegraphing confidence and saying, hey, we've got this, our model works.
But the market is just not buying it. Not at all. Over the past year, the stock has been hammered down a staggering 48%, especially when you compare it to the broader energy sector. This tells you there is a ton of skepticism from investors right now.
So how in the world is management explaining this massive disconnect? Well, their whole narrative is about playing offense in a really tough market.
And this quote from Executive Chairman Bud Bigham really says it all. He's basically framing this downturn not as a problem, but as an opportunity, a chance to get stronger while everybody else is struggling.
So what does playing offense actually look like? It's all about total integration. It starts with their low-cost sand mines. From there, the sand moves along their massive Dune Express conveyor belt, which is now fully operational. And it all ends right at the well site with their PropFlow acquisition. The goal is to control every single step of the process.
And this is a brilliant way to put it. The Dune Express isn't just about saving a few bucks on trucking. They see it as a strategic unlock. It's like having your own private highway directly into the Delaware Basin, giving them access to a whole new set of customers. And they're not just a sand company anymore. They're actively trying to de-risk the business by growing their power segment. They're looking at over 200 megawatts of new projects, and not just in oil and gas, but in markets like industrial manufacturing and even tech. The key here is they're targeting stable, long-term contracts. We're talking 10+ years to smooth out those wild energy cycles.
Okay, so that's the grand strategy, and it sounds pretty compelling. But now let's see how it holds up against the cold, hard reality of the current market.
And this slide really captures that central tension. You've got management saying, we're winning, we're gaining market share, and our logistics advantage is protecting our margins. But then you have the market shouting back, yeah, but Permian activity is slowing down, sand prices are falling, and all your customers are tightening their belts. It's two completely different stories.
And here's the hard data that shows the slowdown is real. The number of active frac crews in the Permian, that's a key measure of demand, has dropped from a peak of around 95 back in March to about 80 now. That's a significant fall-off in activity, and it directly hits demand for what Atlas sells. So, putting all the pieces together, here's our take on what to watch for in the next quarter and beyond.
First off, let's just look at what management themselves are forecasting. They're actually guiding for a modest decline in revenue and EBITDA for Q3. They expect to sell more volume, but that gain will be completely wiped out by weaker pricing. So, they're acknowledging the near-term pain the market is worried about.
Based on all this, we're kicking off coverage with a market perform rating. Look, the company's executing its strategy really well, but the sector headwinds are just too strong to ignore right now. The biggest risk is that this pricing pressure just drags on and on. But on the flip side, the key catalyst we'll be watching for is any announcement of major contract wins for the Dune Express for 2026.
Okay, now for our favorite part, the outrageous but plausible trade idea.
So here's the thesis. The market is being really short-sighted, focusing only on the next couple of weak quarters. We think it's underappreciating the long-term competitive moat Atlas is building. So, the trade is to buy out-of-the-money call options that don't expire until mid to late 2026. This gives you leveraged upside for a potential recovery in the Permian, where Atlas, with its bigger market share and cost advantages, could emerge as a massive outperformer.
And that's our breakdown of Atlas Energy Solutions. As always, this is not financial advice.